Hola a todos. I'm very happy to be here. Sorry, I speak in English. Nobody is perfect. I cannot speak in Spanish yet. And I will try to, in 10 minutes, present you the real opportunity in credit market, because we heard about a lot of things about macro, Trump, inflation, and so on. But at the end, what are the real opportunities? I mean, we need to invest. We need to invest in credit, how to choose it, and where are the opportunities for us. So in 10 minutes, it will be quick, but I will try to really focus on the very important messages. First of all, Edmond Rothschild, overall, we are really focusing on debt, globally speaking, and niche market. So try to extract opportunities clearly. But today, before giving you the ideas, I will try to have a very quick outlook on the credit market and what you have to look, which are the biggest factors that will impact credit market, and why we are here today, and why you can extract performance over at least next year. First of all, you have to look at inflation. Inflation is important because it drives rates up in the past months, and so it's very important to see where we are. And where we are very low, especially in Europe. The target of 2% will be reached early in 25. That's the central bankers told that this morning. So clearly, it's not a problem anymore. So it's really an ancient history. In the US, it's a little bit a question mark. I mean, inflation can come back. Why? Because of Trump, you know that. But where we are today, the point is low. So yes, there's a risk, but we are not anymore at the 8%, 10%, and so on. So inflation is okay. And that's why rates will be cut. We started already. We started in the US. We started in Europe. What we see in the divergence between US and Europe is, like I said, I mean, there's no problem of inflation anymore in Europe. Could be a threat in US. So what you see here, that you should have more rate cuts in Europe, very regular during all the year, but we will have also in US, because there's a monetary policy too restrictive for the economy despite growth. The result of that is what about spread? Why we are here, why we have not. I see just before a presentation about volatility. And yes, you can see spread. Spread are volatile, that's true. But spread just answer, and it's just the answer of global growth. And where is global growth? Yes, we have seen a lot of crises, but we have seen a very huge problem in growth. I mean, here, we go back to zero not very far ago. I mean, and that's why spread was higher, because when you are fear about recession, spread are higher. So today, we are nearly out of the woods, because global growth is around 2%, and we should be there, thanks to the US, and thanks to China still, I mean, try to keep the growth for the population, and you know that. So in Europe, it will be not so much growth, but the impact on spread, even European spread, are linked to global growth. So for the moment, we are out of the woods, and that's why everybody talk about soft landing, and that's great for credit. And great for credit, we have to talk about defaults, because if you invest in credit, the risk is default. The real risk is bankruptcy. We don't see so much bankruptcy to come. I mean, it is a lagging, let's say, indicator, but we try to forecast with all the data we have, and we cannot see the default rates going up to 2 to 3%, not so much and not more. That's why for the moment, and really, not only cash is king now, it's not really the thing. Cash is not king anymore, because cut will be rate. But credit is the new cash. And that's the real sentence today. So let's talk about the opportunities. First of all, we talk about high yield. High yield, you know, we used to name this segment like junk bonds. High yield is a bit different right now. And some time ago, we were quite afraid about the wall of debt coming, and will the company reimburse really all the debt. Just give you figures. It's true that last year, in the high-yield markets, company has to face 180 billion to refinance debt over the next 3 years, where we are now. Thanks to, let's say, the breadth in yield and in spread, globally speaking, there has been a huge primary market. So from 180 billion, now we are just around 80 billion. So there's not anymore a big problem of wall of maturity for sure into high yield. And when you look at the color, believe me, the color shows you that the best part is the high quality of high yield, which is double B. So we don't have to be afraid about the debt maturity. There will be no. So it means also there's no leverage in this asset class. Last but not least, very simple. You don't have even to read let's say, the legend of these figures. When I talk about high yield, the total yield, so the sovereign risk plus the spread, we clearly see that it's not far from the high time. So we have a very restrictive, and the point is not for so long. So you have to benefit from this today, because it will not stay, it will not last. And to explain a bit tight spreads, because people say, wait, it's tight spread. I show you already the growth, so it's normal that we are not so large in spread. We have to look about the duration, which is, let's say, the maturity. Globally speaking, the debt is very short maturity. That's why we can see the spread not so high. If you go to longer maturity, then you have higher spread. So when you put in ratio spread against maturity, it's just fair value. It's cheap, but it's not expensive. And last but not least, we let's say make just an exercise. Just to, when you are investing in high yields, at what point you can lose money on 1 year? You can lose money if the spreads of the average spread of companies went up nearly 200 BPs. So you have a cushion, which is very important. And I will talk about this cushion, because this cushion is so important, because you will not face the volatility of rates, because credit, globally speaking, bring you low volatility profile. And the technicals are so important. On the one side, you see let's say the market, and we see that because debt was and yield was so high at one point in 2002, 2022, 2023, that the market shrinked. And when the market shrinked, and the demand is so high, you can see that. So globally, you have a kind of squeeze that everybody is looking for this debt, because you have only the good company that can issue at one point. And that good company are very good to invest in. On the right side, you see the flows coming into target maturity, and I will talk about target maturity funds. So target maturity fund, so huge inflows. And why? Because it was just a very good opportunity at one point. I will go into directly the opportunity if you don't mind, because time is running. So this is a high yield strategy. That's why I present you the high yield. And one strategy, I mean, works for extracting value, extracting and delivering performance is Millésima. Millésima is a target maturity fund. So what we can offer to you, and I will talk to you about the yield today, going to high yield and the high quality of high yield, because I love double Bs. I don't like the others. And going into here, you will benefit from high spread and less volatility because it's a short-term maturities. So the concept is very simple. It's the basket of bonds, mostly high yield, but some investment grade, and bring them to maturity. And this, when you look at the risk and the return you can find, I mean, is maybe the last, I think, maybe the last opportunities you can find in target maturity fund, because obviously we will have rate cuts, so global yield will follow at the end of the year. So this opportunity will not last. I think it is our last opportunity in this target maturity fund. So that's a very important stuff. So maybe if I have time, this is a characteristic of the portfolio, and I will be here to answer to any of your questions about how the fund is. I mean, we compose the fund. What is the risk inside? So, but you have the figures here. Globally speaking, we just launched it. We have already more than 120 million, but we just launched less than 2 months ago. So still, it is a very good approach and a very good, let's say, opportunity to invest. If I have time, and I think I have still 4 minutes, I wanted to talk to you about a new ideas, also opportunities. Because like I said to you, I like the high quality in high yield. I don't like the low quality because we have, let's say, an overview of the next year. But what about in 2 years, 3 years? It's difficult. So I don't want to take so much risk, in a way, credit risk. And I want to really deliver performance right now. I don't want to wait. And fixed income markets are good to give you, in a short-term period of time, returns, and that's very important. And this is a new opportunity. It's corporate hybrids. Corporate hybrids is very simple. It's subordinated debt from investment-grade company. I don't like so much investment grade because spread is too tight. Okay, could be some return if ever yields are less volatile and yield will go down slowly, surely, which is not sure. But on this asset class, you have more spread because of the subordination. And on this company, which are very solid, we can offer average spread, and we can have roughly a coupon and yield around 5%. So it's not very far from high yield, double Bs, but it's a different risk. It's credit risk is not big. You have a kind of structure of this issue, which is a little bit at risk. And structure is very easy to understand, because what is the rating methodology? Why this big company issues this kind of debt? Because it's good for them. I mean, in terms of reporting standard IFRS, for them it's equities for the IFRS. And for rating agency, S&P, is half equity, half debt. So for them, it's a cheap way to keep their rating investment grade. That's why they use this kind of debt, subordinated debt. So it's a very interesting opportunity as well. And you have here some figures. We're talking about 5%, not very far from WBs. So thanks, because it's very high quality. And also you can see the performance and the total return. I mean, this asset class will continue to go on and to deliver performance as well. So thank you very much. This was these 2 main opportunity, and I wanted to share with you, and I hope you will understand and maybe invest. Thank you very much.